Most investors believe the biggest danger in the stock market is picking the wrong company. But what if the real danger is picking the right company at the wrong time? Because right now, as millions of retail investors are doubling down on AI stocks, as social media calls Nvidia the safest stock in history, and as the world declares the AI boom unstoppable, billionaires, the very same people who rode the AI wave to historic profits, are quietly selling. Stanley Druckenmiller, Peter Thiel, David Tepper, and a long list of hedge fund giants whose moves don't make headlines, but whose patterns have never been wrong at major turning points. Why would the smartest money in the world exit positions they believed in more than anyone? Why now, at the peak of optimism? And what do they see that the average investor simply can't? This video uncovers a pattern as old as financial markets themselves, a pattern that appeared in railroads, radio, .com, housing, crypto, and now in AI. A pattern that predicts not the end of a technology, but the end of a cycle. This is Financial History Uncovered, and today we're pulling back the curtain on the hidden market cycle no one sees coming. To understand why billionaires are selling, we need to go back, not a few months, but a few centuries, to the origins of modern investing and the psychology that shapes every boom. Because markets don't move on technology, they move on expectations, and expectations follow a pattern so reliable, so mathematically repeatable, that historians can map it with the same accuracy as planetary motion. But before we reveal that pattern, let's meet the three modern figures whose recent actions triggered alarm bells across Wall Street. Stanley Druckenmiller, the man who made $1 billion shorting the British pound. The investor who has never had a losing year. A master of timing, buying early and exiting early. Peter Thiel, the contrarian billionaire behind PayPal, Facebook, and Palantir. A man who sees bubbles long before the crowd. His trades are rarely emotional. Their statements. David Tepper, one of the most aggressive hedge fund managers in history. He buys when others panic and sells when people feel invincible. Each of these men predicted the rise of AI. Each of them made fortunes in Nvidia, AMD, and other AI-linked names. And now they're selling. Not because they think AI is a fad, but because of a cycle the average investor never recognizes until it's far too late. To understand that cycle and why their timing matters, we need to go back to the beginning of every major financial mania. Picture the early days of the railroad boom in the 1800s. Railroads were the most revolutionary technology of their time. They shrank distances, collapsed time, and rewired economies. Investors understood immediately. This was the future, and they were right. But being right about the future doesn't mean being right about the price. At first, only insiders and visionary capitalists bought in. Prices rose slowly, then faster. Then, exponentially. By the time the mainstream public understood the opportunity, early investors had already made fortunes, and valuations had detached from reality. What came next wasn't caused by the technology failing. It was caused by expectations exceeding the technology's ability to deliver in the short term. And this cycle repeated again in radios, airlines, computers, .com companies, and crypto. Every time, the technology changed the world. But the stock prices? They outpaced the real revolution and crashed, even as the underlying innovation kept growing. The same cycle is now repeating in AI. And the billionaire exits are the warning sign that we have reached the same expectation gap that defined every past boom. But to understand exactly where we are, we need to zoom in on how this modern cycle formed. The AI boom didn't start in 2023. It didn't start with ChatGPT or with the mass adoption of generative tools. It began quietly, almost invisibly, in 2016, when a handful of researchers demonstrated that neural networks could solve problems traditional algorithms couldn't. Most investors didn't care, but the billionaires did. The first wave of capital flowed in when AI wasn't a headline. It was a whisper. This phase is known as the smart money accumulation phase. Who buys here? Visionaries, contrarians. People who read research papers instead of news feeds. During this phase, Nvidia was a 30-50 stock. AI demand was theoretical, but insiders were loading up. Then came phase 2, public awareness. This began in 2020, intensified in 2021, and exploded in 2023 when AI models demonstrated capabilities that looked indistinguishable from magic. The mainstream woke up, stock prices surged. Nvidia became the market's favorite stock. Every earnings call, no matter the industry, found a way to mention AI. And by 2024, we entered phase 3, Mania. This phase has two defining characteristics. 1. Valuations detach from fundamentals. Companies with minimal AI revenue gain multi-billion-dollar valuations simply for AI potential. 2. Retail investors pour in at the fastest pace. The story becomes so big, so universally accepted, that buying feels like common sense. During mania phases, stocks don't rise because of earnings. They rise because of expectations, because investors believe the future will be bigger, faster, and more profitable than anything seen before. But there is always a point where expectations become mathematically impossible to meet. And that point, historically, is exactly when billionaires exit. Which brings us to the breaking point. Billionaires don't sell because they're bearish. They sell because the risk-reward is no longer in their favor. That's the part retail investors never understand. To the average trader, selling Nvidia feels like sacrilege, like betraying the future, like giving up. But billionaires operate on a different principle. When the odds change, the position changes. So what odds changed? The law of big numbers. When a company becomes too large, its ability to grow at the same rate becomes mathematically impossible. Nvidia reached a point where maintaining its pace would require doubling the entire global data center market, sustaining record margins indefinitely, and every competitor losing market share simultaneously. No company in history has escaped this gravitational force. Not Cisco in 2000, not Apple in 2012. Not Amazon in 2021. When Druckenmiller sold Nvidia, he said something every investor should memorize. When something becomes obvious, you're probably too late. When your Uber driver is bullish, when politicians talk about AI, when the entire narrative is priced in, the smart money exits. 2. Unrealistic earnings expectations. At the peak, Nvidia's valuation implied near limitless demand for AI chips. But two cracks began to form. Competition was accelerating. From AMD, Intel, and custom chips and data center budgets were starting to show early signs of saturation. Billionaires don't wait for cracks to widen. They sell at the first sign of slowing momentum. Market crowding. When a stock becomes everyone's favorite holding, hedge funds, retail, institutions, the trade becomes dangerously crowded. Crowded trades can't absorb selling pressure. All it takes is one earnings miss to trigger a stampede. Billionaires don't like crowds. Crowds can't exit fast. 4. Cycle timing. Every boom has a middle and an end. The middle produces the biggest profits. The end produces overconfidence. Billionaires aren't exiting AI. They're exiting at the end of the cycle's high expectation phase. Here's where most people misunderstand the cycle. They think billionaire selling predicts disaster. It doesn't. It predicts normalization. When expectations get too high, the following sequence always unfolds. 1. Growth slows, but remains strong. AI demand won't collapse. It will simply fail to keep up with mania-level expectations. 2. Stock prices correct or stagnate. This phase can last 36 months. Investors call it sideways chop. Historically, this is where the most painful losses occur, because there's no crash to scare people out, but no gains to reward them either. 3. Money rotates, not exits. Billionaires don't leave AI. They rotate into undervalued infrastructure, overlooked semiconductor plays, AI-powered software, second-order beneficiaries. This is why Druckenmiller didn't move to cash. He moved to better risk-adjusted opportunities. 4. The real winners emerge in the next cycle. After the hype fades, the strongest companies consolidate power. This is when fortunes are made, but only by investors who survived the correction. After every boom fades, investors swear they've learned the lesson, but they haven't, because the human brain is wired to chase stories, overestimate the short term, underestimate the long term, follow crowds, fear missing out. Governments create regulations, analysts adjust models, platforms add warnings. None of it works. You cannot legislate or educate human emotion out of markets. That's why the market cycle repeats exactly the same way, every time. The technology evolves, the psychology never does. Here's the part that should make every investor pause. AI stocks are now priced more aggressively than dot-com stocks were in 1999. Not in hype, in valuation multiples. Nvidia's peak valuation exceeded Cisco's at the height of the tech bubble. Cisco was expected to be the backbone of the internet, and it was. But the stock fell 80% and never returned to its bubble peak, even 25 years later. The top 10 AI stocks accounted for more than 40% of all S&P 500 gains. That level of concentration has only happened 3 times in history: 1929, 2000, 2021. Each time, the boom slowed, even though the underlying innovations continued. Retail options buying hit record highs during the AI run. Retail investors were betting more aggressively on short-term gains than at any point in decades. This doesn't signal the end of AI. It signals the end of an expectation bubble. And that's why billionaires sold. Not because they fear the future, but because they understand the cycle. Great companies can be terrible investments at the wrong time. The technology isn't the risk, the price is. 2. Smart money doesn't predict crashes. It predicts expectation reversals. When everything good is already priced in, the only direction left is disappointment. 3. The biggest opportunities come after the hype fades. Not during the mania, not during the correction, but when realistic expectations return and the market stops rewarding stories and starts rewarding earnings. AI will change the world. It will reshape industries, rewrite entire job categories, and create fortunes we can't yet imagine. But history shows that the people who benefit the most are the ones who survive the cycle, not the ones who chase it. Billionaires aren't abandoning AI. They're navigating the cycle the same way they've navigated every major boom in financial history. The question is, will you follow the story or the pattern? If you want more deep dive episodes that uncover the hidden patterns behind the world's most powerful financial cycles, hit subscribe, drop a like, and tell me which market history you want decoded next. This is Financial History Uncovered, and the next chapter is just beginning.